Hey folks, David Frost, My Strategic Forecast. You're here for another episode of Common Sense Market Analysis. Today is Friday, September 22, 2017. We're looking at a daily chart of the SPY or SPDR, which is the proxy for the S&P 500. Basically, we had a non-eventful day. There was certainly not a lot of voluminous information to report from the markets today. It was a normal, typical Friday afternoon, the majority of the day, not much happens. The volume today was around 51 million shares, which isn't all that bad. It was certainly more than yesterday, but all in all, there wasn't a lot of activity for the majority of the day. So there's not a lot of new information to report. Much of what we know has already been discussed over the last couple of trading days, but nevertheless, we're still going to run through the markets and we're going to get ready for next week because I do think next week will be much more eventful than this week has been. We had this afternoon at 4:02 p.m., we had the autumn equinox, and therefore it will generally have an effect on the markets. It will have an effect on more than just the markets. It's not just a market-specific event. It's a change of seasons, and you're generally looking for a turning point in a lot of different areas, not limited to the stock market, of course, and other markets for that matter. It could have an impact on political events, on geopolitics. We certainly have some saber rattling going on between Donald Trump and Rocket Man. You never know what's going to happen over the weekend. I really wouldn't be surprised. I don't think anybody wants to see a conflict, but I certainly wouldn't be surprised to see something happen between Rocket Man and, our military, or potentially just more saber rattling out of the White House. That's certainly a possibility. In addition to that, we also have an election coming up in Germany. Angela Merkel is up for re-election, and that could certainly have some kind of an impact one way or the other to the markets. So while things seem relatively quiet leading into the weekend, and obviously the market has not been really paying too much attention to the saber rattling going on between North Korea and the US and Japan and other countries that are certainly allies of both of us, that doesn't mean that we won't see something happen, and it certainly doesn't mean that we won't see an impact leading into whether it's next week or beyond. So we'll leave it at that and we'll see what happens, but certainly nothing would come as a surprise to yours truly. Now, putting the rhetoric aside, let's look at the market. Let's look at where the market is, the pattern, and what we have is a remaining bullish pattern, and certainly remaining above the 248.91 level is something that we cannot take lightly. As it stands today, this is a bullish pattern, and it is setting up for higher prices. However, and I'm not suggesting it will, but I won't be surprised, once again, yours truly won't be surprised if this particular pattern happens to fail. We may take a spike higher early next week. However, what happens is, and I mentioned this at least 1 or 2 days this week, is that at these highs and at lows, these patterns have a tendency to fail. And a bullish pattern at highs or a bearish pattern at lows does have tendency to fail. And if that happens, they release the energy in the other direction. And what I mean by that is the bullish pattern should release this energy to the upside as it normally does. However, if it does fail and we get a sell signal and we start closing back below, certainly 248.91 is the first level of importance, and we start closing back below important numbers, then that energy that was to be released on the upside will certainly be released on the downside. So we'll see what happens. Next week is going to be, in my opinion, very, very important for the markets. However, just so we're clear, from a bird's eye perspective, there's nothing wrong with this market today. We're in a bullish position, in an uptrend, and there's no trouble whatsoever from a bird's eye perspective on the charts. We know what we've talked about earlier this week in terms of some of the internals of the markets. I showed you some of the FANG stocks, for example, that have been holding the NASDAQ back, and some of the stocks that have been under what I'll call institutional distribution, namely Amazon, Google, and several others. So we know that there are some things cooking under the hood, but just from looking at the market in terms of the the spider. There's nothing wrong with this market. It's in a bullish position. The IWM is extremely interesting. The IWM has been absolutely, without a shadow of a doubt, the strong horse. And we know this is my favorite leading indicator on the up and the downside. And right now, my favorite leading indicator has made a new high, a new closing daily and weekly high. That is absolutely something that I have to take very, very seriously. It's in an uptrend, however, is extremely overextended on a very short-term basis. So there is some overcooking going on in the IWM for certain. It's overextended, long in the tooth, whatever catchphrase we want to use, certainly has gone a little bit farther or much farther than even I thought it would. It has been the strong horse. But what I want to show you is, and we only look at this chart from time to time, but remember the monthly chart. This is a trend that has been intact for quite some time. We have this monthly trend that has, as you can see, we've been riding this trend line for quite some time. We broke below it. The market has tried to rally back, or has rallied back to this trend line that originally happened in November of 2016, and we've been riding this trend line ever since. I can't really see it too well on this chart because we're at the top of the chart, and there's nothing I can do about that unless I adjust all the numbers. I can't do it right now. But what we need to notice is, or pay attention to, is that if the IWM should close the month of September, or any month for that matter, above this trend line, that's going to be something we have to take very, very seriously. That could be in a breakout mode. So I'm watching this very, very closely. At the same time, I'm telling you, and have been telling you, that the market should, and when I say should, it's because of what the cycles tell me. All right, so the market should be in a corrective state at some point between now and the end of October, beginning of November. We talked about this at length. We talked about it ad nauseum. The market was going to correct from at least the middle of July, beginning of August, all the way down through the end of October. Okay, so we had a little correction, and the market bounced back, and it made new highs. So that original cycle I was looking at failed. Doesn't mean the market can't correct until the end of the cycle, which I think ends at the end of October. I know that's a lot of stuff. Just go with me on this. But when I look at the IWM is making new highs. The IWM is the leading index. It's my favorite leading indicator of the markets. I can't ignore that. I have to take this extremely seriously. So there are divergences out here with no uncertain terms. I'm looking at everything, believe me, and I have to take this with the utmost of importance. So as far as I'm concerned, the only thing that I'm looking at right now, since we've already made a daily chart new high, closing high, and a weekly chart closing high in the IWM, the last thing that we're looking at is where is this month going to close? Now, whether or not it closes above this upsloping trend line it's not the end all be all. However, if we do close the month of September or any month above that trend line, that's going to be further bullish behavior with no doubt whatsoever. Now back on the daily chart before we move on to the next index, do I expect the IWM to be just a runaway freight train from here on? No, I don't. It's got to pull back. It's going to have to pull back. But remember what I always say, on both the up and the downside, markets can certainly go a lot farther on the upside than people expect or believe, and a lot farther on the downside than people expect and believe. So while we made new highs, it's certainly overextended. Don't rule out that we can go much higher. I think across the board, next week's going to be extremely, extremely important. The transports continue their uptick or upswing, up another 35 points or almost 0.4% today. So the transports are making a run for their high or previous high, which is also an all-time high. So the question is, are the transports going to confirm with the IWM at new highs, which would be very bullish for all markets across the board? Nothing we can do with this right now except be a spectator and see if that happens, or do we fail and we put in a lower high? We'll see what happens next week. I'm watching the transports, as you know, extremely closely. Heading over to the gold market, no surprise, last night we discussed the fact that we should be at least short-term support for the gold market. We came into the 50-period moving average. We're at an area that we always discuss that would be supportive of the market, anywhere between 1,300 and 1,290, 1,292, in that neighborhood. That's where we did find support, and today we had an uptick back up to 1,300. Why was this support? Two main reasons. Number one is from the pivot top, and this is a sign of a reversal. They don't work 100% of the time, but they work much of the time. And we certainly had a couple in recent past that didn't work, but this one certainly did. From the pivot high to yesterday was 10 trading sessions in a row. You know how I like the number 10. I like it very, very much. That was one reason. The other reason is we were at an interesting level of support. First, we had the green candle low, and then we had all of this chart support in here where the market spent a lot of time going back and forth. This is called chart vibration. This is where the chart is telling you that this price level is very important. This is an area where the market consolidated before breaking out to new highs, or not new highs, but higher highs. And we know that markets love to come back in and check in at former breakout or breakdown areas. That's exactly what we did. This is considered a breakout area. The market consolidated and broke out. The market found a top, a pivot top, and it came back in. It came back in for 10 trading sessions, which is an important number. And where did it find support? Right in and around the former breakout area, which also coincided with an upsloping 50-period moving average trend line. That's exactly where the market stopped short and reversed today. And it was a decent up day for the gold market right off that 50-period moving average. So no surprise that we had an uptick in the gold market today. Silver, not quite the up day that gold had, but we are finding at least short-term support, or it appears that we're finding short-term support at this level, at this former breakout area. But certainly this chart doesn't look, at least from today's perspective, as strong as gold looked today. Not that gold is strong. We just had a nice bounce off that area. Not so much in the silver market. They trade in tandem most of the time, but certainly day by day, each and every day, they don't necessarily have to trade together. Gold was stronger than silver today. We're not going to make much more out of it than that. Crude oil continues to edge its way higher. This isn't the ideal bullish pattern consolidating underneath the 200 period moving average. It's kind of ticking up and it's sloping up, and it's not ideal. What we want to see for the ideal pattern really is something that looks more in tune with a pattern that has an up move and a slight pullback consolidating. That's where the market really begins to build some energy for the next move higher. What this one's doing is it's kind of edging its way higher, and that's not necessarily building, in my opinion, the same type of energy as this one would. So we'll see what happens. These patterns that have this kind of up move and then they creep higher, they have a tendency to fail more often than the bullish patterns that consolidate in a downward fashion and build energy to go higher. These patterns aren't the greatest, but it is edging higher, and I still think that we have a shot at $52 a barrel. But the longer this kind of goes on for, the more I think we'll probably do what I'll call a tag and tank, tag the 200 period moving average, and kind of have a reaction off that in a downward direction. But we'll see what happens next week. Still is in a short-term uptrend on the daily chart. No two ways about that. And where we get this pattern from, just as a refresher, is this bullish pattern on the weekly chart is really not complete yet, in my opinion. We really need to come in and tag the 50-period moving average, which is the blue sloping trend line. And I'm surprised nobody's asked me yet what this purple line is. I'm not going to say anything until somebody asks. But 51.75 is where the 50-period moving average comes in at. And I think we really need to, at a bare minimum, tag that, pierce it through, and that'll really complete, for the most part, this bullish pattern off the weekly chart that's been in development for quite some time. Very similar to the gold market, we had a slight reversal today in the bond market. Should come as no surprise. I pretty much had the same conversation yesterday about the bond market. Yesterday was day 10 trading sessions down, and we had a little bit of an uptick today, right off the 50-period moving average. Even though we closed below the 50 for 2 days in a row, here we are now back above the 50. Again, 10's a very important number, at least to me and what I believe to the markets and to the charts. So what I think is going to happen with bonds, and remember, these are the bond prices, which are opposite yields. So as bond prices rise, the yields go lower. And what I think is likely to happen, one of two things is going to happen in my opinion. Either the stock market's going to continue grinding higher and the bond market's going to put in a bearish pattern, meaning going sideways for a while, and then have another leg lower. That's a likely scenario if we see the stock market continue higher. If we see the stock market falter and have some kind of a correction, then we're likely to see higher bond prices. And I think we're going to start to see some evidence of all that begin to at least unfold at some point next week. The last market we'll take a look at tonight is the dollar. Took a little dip down in the dollar today, recovered back towards the 20-period moving average. We're not going to draw any evidence or any information from what's going on in the dollar. You know how I feel about the dollar. I think it's destined for 88 cents on the dollar. At that point is which I'll be looking for signs of a reversal. Unless that happens, or we see some kind of other evidence that I'm not seeing today on the bullish side, I'm just going to leave the dollar alone. And with that, I'm going to wrap it here tonight. I'm David Frost, my strategic forecast. Thanks for tuning in for another episode of Common Sense Market Analysis.